All right, good morning, everybody. There are the spot gamma levels. If you want to capture a screenshot of that. All right, so we can see a nice recovery candle for Hong Kong. They're still defending the lows. Lots of wick across the bottom here over the last week. Still unable to really break out. Big sellers defended that level the last two times we've been up there. They made a run for it, closed near the upper part of the day. We'll see the follow through tomorrow. For Japan, nice gap up, but they are fading back down. A little bit of an island candle. Very likely it's going to close this gap in the after hours because their market's already closed too. For Europe, they had an inside day breakout, just barely, kind of a nice follow through from that really big day. But since then, faded back down inside. Right now, it's kind of on the line. There was some Tesla news. They're lowering the cost of their vehicles yet again, and the market didn't like that. Even though the markets were closed on Friday, the bond market wasn't. So we really want to keep our eye on how yields respond to the bonds falling. It's going to be a really big deal today. This is going to be a quiet day in the grand scheme of things, right? For the whole week, we've got a lot of really big data points that mean a lot to the Fed and is going to greatly impact whether or not they raise rates or pause here. Not today, but this week. So this is the calm before the storm. And I really want to stress that. Whatever bias you had last week, we're bullish, we're bearish, whatever, put that in a bottle because one, it's a new week. And two, the market's going to get a lot of data that the Fed is going to use in its upcoming FOMC meeting. Also, even though the futures are open, Sunday night, and they were open, all night long, the market hasn't priced in the weekend news and definitely hasn't priced in that Friday's economic data, non-farm payrolls and everything else. And this is typical. It's a normal thing. The markets price things in at the open. It's price discovery 101. It's what happens at the open. It's why we get so much volume and so much violence and volatility. I continue to see newer traders trying to trade futures or just trying to day trade, and they target that 930 area, and then they can't figure out why they're having a hard time and they're losing and blowing up their accounts. That is the most difficult trading period in the whole day, where the market is pricing in news and it's not the candles moving the market, right? It's not like there's a setup, a pattern, a follow through. It's external data pushing the market around. So, if you're losing more often than you win, quit doing the hard stuff, quit trying to trade the open, find another area to trade, and you'll start growing that account out instead of blowing it up. So we're going to get a lot of Fed speakers. They're just chipping teeth, looking for unity in their messaging, right? Every one of those Fed members want to differentiate and stand aside and be their own person. but they're also going to toe the company line. And that's what we really want to identify. What is the company line right now? Right? What drum are they beating on? And the market completely is ignoring the Fed. The Fed is saying, we're not going to cut this year. We're going to raise 1 or 2 more times and likely going to just hold the line for the rest of the year. No cuts. And the market says, yeah, you're going to cut 4 times this year. So there's this huge separation between the Fed's forward future view and the market's forward future view. And it's really screwing up the day-to-day market. So if you're finding it hard to swing trade and get reasonably decent options trades, nobody knows what's going on. Nobody can see far enough out, right? You pick a narrative. So with these Fed speakers, we really want to find the narrative. All right. The Bank of Japan has been running this one system under leadership for like a decade or more, and they're passing the baton to a new generation, a new leader at the BOJ. In Europe, not too long ago, a newly elected leader was just talking. That's all, just kind of giving some hypotheticals on some things that she wanted to work on as a newly appointed leader. And she slipped and blew up the European markets, just wrecked them. And of course, she lost her job. She didn't stick around for very long. She was gone. And that's always a possibility. All right. So we got this new guy coming in. One thing, that's all he's got to do. He's just got to slip up a little bit and blow the market up. So be very cautious over this Bank of Japan governor nominee. I'm not even going to try to butcher his name. But this guy, taking the reins, one mistake, it's all it takes. Just one word out of place, and there goes the market. We have additional auctions today. They're very likely going to be the only econ of the day that has any real weight to it. So 11:30 auctions, that's it. Now around the world, we're going to get CPI and PPI from other nations, but that's not for us, right? That'll be in the overnight. We're getting FOMC minutes this week, right? It's the minutes from the last FOMC meeting. We're going to get our own CPI. We're getting the 10-year auction on Wednesday. It's a really big deal. The 30-year on Thursday, and banks are going to kick off earnings season this week. So it's a really big deal. It's a really big week. Today is the calm before the storm. All right, as usual, when we come in from a holiday, we've got really light trading on the books. Generally we run around 100,000, anywhere from 100 to say 150, 180. And it can get a little squishy, maybe 80, 75, 80 if we're running on the light end waiting for some econ. And this morning we're sitting down at around 637. So it's really, really light out there. And again, this is kind of typical after a long weekend. So Can't really read much into this. Obviously, it's picking up a little bit now. But with that control bar here, that's going to set our tone. Now, one thing about brokers, it's kind of worth mentioning this real quick. I always end up having to mention it after holidays. All brokers struggle with trying to resolve how to show you a little bit of data from Friday when the market wasn't open on Friday. So one of the things that I like to do is just wrap it all together. Take everything from Thursday into Friday, or let's say it another way. Thursday was the end of the week. Just shut it down there. Any data that you got since then, treat it all like Globex. So anything that showed up on Friday, just treat it as a part of Sunday's price action. Sometimes you're going to find this in, say, the middle of the week, or at the start of the week. We'll be gone on a Monday and we start on Tuesday, something like that. So think of the Friday after Thanksgiving. So the market always struggles to represent this correctly, especially for open, high, low, close, and Globex levels, high and low, dealing with our ranges. It messes up floor pivot calculations, all kinds of stuff. And there just really isn't a good way to solve it. I've just wrapped it all together. Consider the market closed on Thursday, and anything that we got since that close on Thursday is a part of one day, today's. So the close that we want to focus on for our open, high, low close is last Thursday's close, and then the high of last Thursday and the low of last Thursday. Right now, this outsized bar is in control. Think of it like a liquidity vacuum. We're closing the gap, so to speak. Once we get back down to the bottom here, we'll then, decide what we're going to do from there. Either expand in a breakout and challenge Thursday's cash open. From that Wednesday's low and then Thursday's low, or we find support down here in, say, a double bottom bear trap style, and begin to rebound and work our way back up through the box again. We are expanding just a little beyond the VWAP in a measured move, equal to the last measured move. All right, 10-day, 30-minute volume profile. There's some real shallow areas here. Basically underneath Thursday's low. Remember, we talked last week about how on Thursday it found support somewhere and it didn't fall through that air pocket. It was really surprising that it managed to hold up, but it did. So now the idea is, if we break Thursday's low, we're going to go ahead and wipe out that air pocket and look for stability around 40.80. Underneath that, we got another air pocket, and we'll look for some stability around 40.50. We are right underneath the point of control, which does tend to act a little bit like gravity, but it won't hold the market there, right? It's more of like a cog line. All right, mapping out the 5x5. This is a 5-day, 5-minute chart. Obviously, there's more than 5 days here, because at some point I changed how many days we're showing, but it's supposed to be a 5-day, 5-minute chart. So these volume profiles are reading Friday but we just want to put those two together and look at Thursday individually and all of this individually. We don't have a VPOC from Thursday to deal with. And in fact, we don't have a VPOC until we get below 40.43. And if you remember from the other profile, 40.80 and 40.50 were areas where we expect to run across these volume shelves and are likely to pause before we get down to that VPOC. For an upside breakout, we still got 41.70 to deal with. All right, so the daily chart is doing a pretty good job. Now, I spoke too soon. Wrap that blue day in with that red day, and that would just be one day. Now, there is an indicator on Tradeovate that will draw these candles in a merge like that. It'll be this shadow candle, kind of like what I just drew, where it'll draw the open and then it'll draw the low and the current price. So it'll have this shadow candle with a wick on whatever time frame you want it to be. So it'll merge these candles together and show you this shadow candle behind it. TradingView has the same thing, I believe. I don't remember what the indicator is called, but it'll do it for you. The main thing you want to focus on is Thursday's levels. Right now we are inside day for Thursday. We're underneath the close. We want to focus on Thursday's open as a line in the sand. We get below that, then we focus on Thursday's low, and then we mess with this really big bar back here, which is March 31st. All right, so in the bigger picture, this candle is still in control. The expected move for the week is more narrow than last week, even though last week was a 4-day week. You can see the size of the box for this week. If we were to set it over last week's, you can see how much less volume there is. Volume's the wrong word. How much less volatility there is anticipated for this week, which really doesn't make much sense because of all these really big things that are on the agenda, right? And the only logic that I have for this is events like FOMC or really big events like what we have on the agenda this week, CPI, PPI, they're volatility suppressors. Now, when I first heard that phrase, I pushed against it automatically and said, that, what are you, crazy? You've seen the market when the FOMC comes in or CPI? They're big sweeping moves. There's nothing suppressed about that volatility. It's big. But I was only looking at it on the day of the report, right? I was considering what the charts look like on CPI day or on FOMC day. But that's not what the phrase is talking about. Leading up to FOMC or CPI or PPI, those events are volatility suppressors. The market slows down, quits making these big gyrations, these big moves, and has suppressed volatility as we go into one of those events. And absolutely can't push back against that at all, right? Go back and look at the charts. Most of the times we'll get these sideways doji days and doji weeks into one of those FOMC, PPI, CPI days. Now, it's not always, right? The market doesn't always do something, but most of the time they suppress the market. So this lowered volatility that we're seeing here on this box it makes sense when you think about the anticipation of the week is likely going to be muted, suppressed while we're waiting for CPI and PPI. All right, we're looking at distance from the 10 in this lower indicator. We had made the rollover, crossed through and above, made the rollover, and we're working our way back down to the 10. We have not yet made it. And we don't have to hit that 10, just more often than not we do. Right? If you go back and look, there's been periods of time where we've crossed through and above, made the rollover, came back towards the 10, didn't get there, and then ran away from the 10 again, came back towards it, ran away again, came back towards it, and then finally we got into it. Same thing back here, right? So there are times where we just don't complete the cycle and swing back down again. Having said that, we're 0.5% away from the 10-day. If we continue with this sideways action, the 10 is going to come up to meet us. We don't have to go down to it. It'll come to us. So unless we expand to the upside soon, we're going to make contact with that 10. For the 10 week, we're still more than 1.5% away from the 10 week. And again, all we have to do is pause here and the 10 will finally come up to us eventually, but it wouldn't be this week. So kind of looking for that reset here. You know, are we going to come down and get into that 10 or not? Now, Mott Capital has this really good chart right now that shows this large apex with a sine wave. I don't have the chart queued, or I would show it. Basically something that looks like that, and then he's got sine waves on it. Now, we're not at the end of this wedge yet, but markets don't normally get to the end of the wedge. Right? Long before we get to this peak, we break out. Some numbers say that we rarely get past 80%, right? And so there's like this 20% of the wedge that we never get into. And more often than not, it's more of like 70 to 75. So we're really close to this spot where we're going to break out. If we continue the move, then 3,900 is on the table. Otherwise, we're looking at a breakout and a measured move of this breakout. The way you deal with wedges, measure the largest part of the wedge. And then move that measurement to wherever we break out. Now that's 100%. There's usually two ways to approach this. One is to use 50% of that measured move. And the other one is to use 100% of that measured move. So you can see that would get us back up to all-time highs. There's a few ways that that can come about. One would be, say, the Fed just starts cutting rates like crazy and the market really likes it and takes off, or Russia bends the knee and bows out of the Ukraine. That could certainly spike us and turn the market into some exuberant explosion like this. I don't think that's on the table, personally. I just don't see this as even a viable opportunity. But it's there, right? That's a solid wedge. That's how we measure them. And that's the projection. So another way you can do it is just use this quadrant line and then plot it. What you're looking for is from the breakout. This is showing the measurement from the highest point of the wedge, but it gives you this distance. We can see how close my 50% mark was. Yeah, not too bad. $4,500 would be 50% of that wedge. So something to think about, right? Bigger picture. They would need a narrative to do it. Price alone, just working through this cycle, wouldn't be able to do it. It would have to be something from the bonds, some global event, a situation, something. But that's not really going to be for today. But really consider the move back down, because we're not at that 75, 80% mark yet. So there's still room within this wedge for another run back down, and then a tag, and then a run, possibly back up, or even a breakdown from there. And I didn't plot it out, but that measured move would also apply to a downside move if we happen to break down. And really, the downside measurement matches up with forward projections on the S&P with earnings, right? So at least the downside move comes with confluence behind it. A little bit of energy and some Bitcoin, not even very much. Otherwise, we've got a pretty flat market out there, which makes sense. That really low volume that we saw in the S&P. All right, so here we've got kind of the heavy hitters in the NASDAQ. I went ahead and added Snow to this list and AMD since they're now in the NY FANG, that new NY FANG index. So I put them in this list. We got a market maker move on nearly every one of those monsters of tech. And the market maker move comes from here. When this front end implied volatility average is greater than the back end implied volatility average, you'll get a market maker move. All right, so Tesla's got a TRB set up here. And we already had the recovery candle. That's the blue candle. But we're stuck underneath that 185. There we go. And looking at things so far with the bad news and everything else, we're not going to get that TRB follow through. So another way that the TRB sets up is instead of having one single candle as the recovery candle, and then the big gap up and the breakout and the run through that we've covered multiple times. The other thing is where it builds a base down here and we get, multiple days, even a week or two, where we're just sitting at these lows. We can wick down, make new lows, deeper lows. We can even wick up a few times. What we don't want to do is cross above this level here, that 191. We don't want to do that because that'll start triggering through all those stops, like the machine gun pivot reversal play from the strat. So we want to stay below that level and just build a really solid base down here. And of course, if we wick a little lower, say, get down into that 178, 177 area, we're just looking for it to stabilize, hold the line, build a nice little base, and then we get that breakout day. We don't have it yet, right? And say there's the TRB from before, the big recovery day. You see how far we had gapped down that day from the previous day's close, then the rally up and the follow through. So they're worth watching for when we get them. And since there's a lot of setup behind it, we don't have to, jump in early and hope it all works out. We can just wait for the play. So we don't have the play yet. Looking at, pre-market today, we're supposed to have gapped up and be ready for the big run. And that's not what we're seeing here. So whether or not it has earnings wouldn't affect the TRB setup because it's a one-day trade with maybe a second day as a follow through, right? It would be in and we'd be right back out again. The idea is to get back to the top of the range, and with a really good TRB setup, we would make that entire move in a single day. It's an outsized move, and that's the whole idea, right? That's why we want to focus on something like the TRB, because it makes such an extreme move so fast. As for Does it have earnings coming up? Yeah, the banks are going to start that earnings process soon. They'll be kicking off this week. And if you're using a broker like Thinkorswim, you never have to ask where earnings is. It'll show you down at the bottom. And you can go to Google and ask Google. You can, go to Yahoo Finance, but on Thinkorswim, just look down at the bottom of the chart. And if it's not showing, like mine wasn't showing, right? There's no data there. Just grab the chart, drag that sucker to the left till it shows up. If it's not down here at all, you got to turn it on. So you can auto expand corporate actions, but then you also need to be able to see those corporate actions. Go to equities, show corporate actions, check that, and it should show up. And that way you never have to wonder if earnings is coming. Thinkorswim has an earnings tab, by the way. So here's the fundamentals tab. You can look at the different ways that Tesla earns. And then you can look at their earnings tab and see what they have done during the last, say, 2 years, what the earnings per share estimate was, and then what the anticipated earnings per share was, with an at the money straddle projection also. And then it says right across the top, earnings are scheduled for April 25th. It just kind of gives you everything you need. All right, we had a failed flag set up on Apple, but the follow through made it nearly 50%. And now that failed flag play is done. Now we're going to be watching for this 161.5. See if we can break through Thursday's low, 161.8. This is a really nice trend. But the issue right now is this just a pullback or not? So one thing you can do is measure this distance from the last pullback and then plot that here and see if it's met or exceeded that same pullback. Not yet. 160.77 would be the same distance of a pullback as the last one. It doesn't have to give us the same distance of a pullback. If the pullback is more shallow than the last one, say it doesn't pull back as far and then it continues to run, it just shows that traders and investors were willing to step in and take the place of those who were getting out. They were willing to step in quicker, sooner, more aggressively than the last time. So if we exceed and go deeper than we did the last time, then it shows a lack of willingness to step in and take the place of those who are leaving, right? So it doesn't have to stop at the same spot. Amazon's not selling off as hard as the other FANGs. Of course, it already did take a good beat down last Wednesday. $100 still continues to be a psychological level. So if we continue this fade this morning, that'd be the target. The gap close, well, the gap is already closed. We did that on Thursday. So we closed it and then we rallied back off of it. And I talked about that Thursday. Now we're going to be looking to see if we can get through that $100 and actually close below it this time. NVIDIA also weak, had that failed flag play, but it didn't follow through the way Apple did. We've got an island down here. This is an island reversal. Now, the bad thing about an island reversal is we can't confirm that it's an island reversal until it actually reverses and it gaps back up and comes back up into this area. And that's not today, right? Because we can't rally back up. We have to gap up for this to be the island setup. And we're obviously not gapping up today, so not today. We're inside day across the board in just about everything, which kind of makes today an easy day to trade. All you have to do is wait for price to break out of yesterday's level. Simple enough. I know everybody thinks they want to trade a trend, but starting the day like this, ranged, and then getting the breakout and then the trend, that's a really nice setup, right? If it already ran 2% in the pre-market, has, broke out to the upside or the downside, and it's made a big run, and then we open, well, that sucks. The market's already made the big move, right? It very likely isn't going to give you another 2%. But we're starting ranged, and that means the big move is still there, has the potential for a big move still there, right? And much more likely to have a good follow through. Just keep in mind, with the big data on deck this week, we could stay range bound most of the week. So while I think we're very likely going to break down and break out in these FANG names, I think we're just going to wick down and then come right back in again. And some of these are looking really good, like Facebook. It's sitting right up against those highs. All it would need is just to find a little stability in this pullback and continue to run. And it's right at the 786. Same thing with Microsoft. Really nice expansion Thursday. A little bit of a pullback now. See if we hit that warning center or not. Stalled out at the warning center, couldn't make it through. And we're at the 786. So right at the measured pullback. So Microsoft and Facebook are primed for this really nice pullback, bounce off of support, rally up, break through this last near-term resistance, and then an expansion. But it doesn't fit the narrative of the rest of the market, right? Which is kind of more pressing than the candle setup that we have. You can see how Google's kind of leading the way already. It's pulled back more than that 786. So it's broken the flag or the trend that we had. And right now that 107.22 is the line in the sand. It's the 50% mark. Really needs to keep that. I think PayPal was the other one. There it is. So a little bit of a pullback. I think it's still above that 786. Just barely. Barely counts. So 3 names in the fangs have this set up. You know, if you kind of poke around, you might find a few more. Liquidity tells were Netflix and Tesla, and both of those two are getting whacked hard this morning. So with those two, we're looking for an inside day breakout, which would give us like this double bottom bear trap setup. I would expect that it wicks through, continues to move a little deeper through the morning, and then look for stability. If it completely expands 100% beyond Thursday's level, that'll kind of be a nice little heads up. So 176.32, we shouldn't see it go down more than that if we're going to expect this to recover and come back in again. And 261.5 for NVIDIA. It shouldn't go that deep, right? And NVIDIA isn't even back down to yesterday's lows yet, let alone getting the expansion or the breakdown. So, you know, the takeaway here is we're inside day, we're ranged, and we've got a market that is very likely going to sit and wait it out until we get the econ that it's looking for. And we might see little pockets that turn bullish or bearish or kind of expand a little bit. But in the bigger picture, we're not going to expect any real significant market change until we get those data points. Everybody be careful, be safe, have a good day. I'll see you all tomorrow.